Well, g'day there, traders and friends right around the world. You're here with James on behalf of Pivot Point Trading. What I will say from the outset of this video is that it will not be a routine market update, which I regularly do for people on this YouTube channel. Instead, by nature, it is very, very serious. The reason why it is so serious is because we haven't seen parallels between the current state of the market and what we've seen close to the 07-08 rollover and also the bear market, which started at the turn of the millennium. Right now, we are in a very precarious type of situation. This is some form of a slope of hope rally, in my opinion. And what I did over the weekend in that pro analysis class is go through in a detailed manner exactly what I'll be doing upon certain criteria being met. I went through two specific outcomes or doors, which is what I type or what I called them at least, as to the criteria which I'd need to see before I start opening up a long-term hedge on the Dow Jones Industrial Average. The Diamonds is my ETF of choice, but you can apply it to the S&P 500 and the NASDAQ. Right now, there's a lot of complacency in the market. The market has rallied 1,200 points since late September, early October. But where we're trading at right now is really where the market itself is going to unveil to us what it has not only in store for us for the rest of 2015, but more so into 2016 also. Again, I haven't seen parallels between where we're trading at now, seeing the backtest of some of these long-term simple moving averages. Not only that, but also horizontal areas of resistance. Not only that, but also some weekly fan lines, which have been in effect since 2009 and which we broke down below. Throughout the August capitulation, I also spoke about long-term divergence, which has been setting up for over 2 years on the Dow Jones Industrial Average, something which I personally haven't even seen since the mid-1920s. These are all very important factual types of analysis techniques, which I've gone through over the weekend and just said, look, this is what I'll be doing at these certain key areas, and because I'm doing it, I think you should at least pay or at least listen to what I have to say about the current state of the markets. It is a little bit different to the mainstream media consensus, I get that, but at the end of the day, they do not have your best interest at heart. Outside of that, traders and friends, it's a really, really opportunistic time to be trading the market if in fact you understand cycles and also technicals, because right now there isn't a whole lot holding up this market. This has been a very low volume rally higher, mostly from short coverings. People have positioned themselves at the wrong location on the chart, and I do expect this market, if resistance does hold, to roll over very close to where we are currently trading. At the moment, price is within 50 points of the 100 simple moving average, and it's within 350 points of the 200 simple moving average. Using technical analysis techniques, we can quantify our risk very, very easily, and our reward on the trade itself is infinite. I mean, it's not infinite as if the market will go to zero, but in terms of a major move, in terms of a transitional market between that of a bear market or a bull market, which we've seen since 2009 and potentially the beginnings of something much more sinister, I mean, it really does weigh into the fact that you should be understanding, or at least learning more educationally speaking, about the market and how you should be at least analyzing the market and what to expect moving into 2016. Now is the opportunity, potentially in the past 7 or 8 years, to hedge yourself. If this in fact is turning out to be the first slope of hope correction back into various levels of resistance. Again, this isn't going to be a weekend market update. I went through some analysis, which I did also cover over the weekend in that analysis class, both on Tuesday and Wednesday. But if you are looking for, again, really detailed and precise analysis, I'd really encourage you to take the time and have a look at that educational facility. This week's class did go for 1 hour and 35 minutes. There's also a backlog dating back just over a month. So there's either 4 or 5 more classes up online that you can go through and have a look as well. Just to learn a little bit more about the current state of the markets, notwithstanding, again, included, some of these individual trade setups. Obviously, we're moving into earnings season. From our list, Netflix and Goldman Sachs have reported earnings, and it is going to be a very busy week. We've got IBM, Amazon, Boeing Airlines, Caterpillar, and Google all reporting this week. So in terms of favorite types of trades, or at least ETF types of trades, it's definitely long-term trades on the overall sort of position and location on the chart of the Dow Jones, of the S&P 500, and the NASDAQ. One quick thing which I will speak about also is the fact that the transports have been leading this market. Since they capitulated, or at least broke macro support leading into May 2015, you can see that they have been acting as resistance. We got 2 back tests throughout the month of June. That failed. We came back down to another macro area of support just around 8,000. We've had 2 little staged rallies between then, but they've both failed as well. what I want to draw to your attention right now in terms of parallels or intermarket analysis is the fact that even though the industrials, the S&P and the NASDAQ have been relatively bullish, not only for the past 2 weeks, but this week in general, what we're seeing on the transports is very, very cautionary types of signals. We've seen what we call the one black crow on Tuesday, and even on Friday, we have very much similar to that, a one black crow, but also an engulfing type of pattern on the Friday. So the transports, which have led us and continue to lead us in this transitional change, are already screaming out, be very careful. The transports themselves haven't even made it all the way back to the 200 simple moving average. And we're really starting to say, well, potentially this may be the next point in time where the transports roll over, which also works in our outlook, our forecast of not only the industrials, but also the S&P and the NASDAQ. So if you really want to get a whirlwind of technical analysis and how all of these types of resistance levels are coming together, where it's really X marking the spot in a certain location, and then have contingent criteria, which I am personally looking for before I start taking on put positions on these markets again, I'd encourage you to have a look at Pro. All right, it's only in Pro where I go through that and give out essentially educational facilities in these trade setups and executions. So on that note, have a fantastic weekend. Please stay safe in the market. I wouldn't be doing anything foolish in terms of buying any of these or buying the market and buying into the consensus of the majority that everything is okay. There's a lot of things under the surface setting up, and this is the perfect area or location on the chart, if not within 300 or 400 points higher, where we're going to see a rejection if in fact we are setting up a legitimate trend reversal, that of a bull market into that of a bear market. It's not to scare anyone, but it's just simple, legitimate analysis, walking through the steps through trade confirmations and ETF confirmations on the overall markets themselves. So have a fantastic weekend. I encourage you to email me, success@pivotpoint-trading.com if you want to learn any more. Outside of that, have a fantastic weekend, everyone. I'll be back with you during the week for some more market updates. All the best. Goodbye.